thanks for being here. Hopefully I can kind of address what's gone on and really title this Looking Ahead, because that really is what people want to know, I think. That during this month, if you've watched CNBC or read different periodicals, magazines that kind of look back over what happened, why did it happen, what was the result of it, and that's all interesting, and certainly we want to learn from what has happened. But really what's more important is learning from what happened and what's happening going forward. How can we invest? What decisions can we make and capitalize on what's going on now and what may be coming down the road in the months and years to come? Well, one thing that I like to start out doing is, instead of diving right in, I want to take a step back, because it's easy to get caught up in the day-to-day of what's going on. And certainly, I was out doing these a year ago, and it was a much different environment. There weren't many smiling faces when I looked out at there, and there were long lines of people to talk to me afterwards and say some not particularly nice things, as if I was the one that caused the financial system to collapse. But as we kind of step back, people get so caught up in what's going on in the day-to-day minutia that we forget about kind of constructing our overall portfolio, our overall investment goals, looking at long-term. And that's one thing that this crisis has done, is talking to clients, it's, I guess, replaced what long-term means. After a period of calm, long-term comes to mean, if you talk to some clients, it was 6 months, a year. That we would say, don't be heavily invested in equities if you're going to need that money in the next couple of years. Well, no, long-term is a year. The market won't go down. It can recover in a year. Well, unfortunately, we've seen that can't be true. Now clients are readjusting their expectations and realizing that long-term really is more long-term, 5, 10, 20 years as we look out. And when we look out, as you organize your portfolio, there's been studies done that we spend a lot of time with market security selection, what stocks to buy, but really where your overall return comes from is really a stock, bond, cash allocation. And that goes back to the long term. It's like building the foundation of your house. What are you going to have as equities? What are you going to have in fixed income? And what are you going to have in cash? And that's not going to change. Even with the tumultuous time we had at the end of 2008 and early 2009, it's not going to change. You have your plan there. And then you add, keeping on with the house analogy, you add paint and drapes and carpet, and that's kind of the security selection, mutual fund selection, fixed income, the specific securities that you put within this overall structure. And obviously, depending on what your risk tolerance is and what your investment horizon is, will depend on that'll make the difference on what is stocks, bonds, and cash. And you can expect, again, as we've learned, as you want higher returns, you're going to have to take some higher risk, and we've seen what that can result in. I think investors got a redefinition of what risk is, and there are risks out there. Investing in equities is a risky game at times. Over the long term, it tends to be the risks are mitigated, but in the short term, they can be pretty nauseating at times. And this illustrates that as you go out from 1 year, any 1 year period over the last 60 years, you can see that any 1 year, the S&P's been down 40%, up 50%. Well, that's a pretty wide range, but if you go out 20 years, again, looking long term, you can see that it's never been negative over any 20-year period, and it's been much more compressed, between 18 and 3%. So 3% over 20 years certainly isn't great, but it's not losing, and it's not losing a So again, it's important to have that long-term goal. And I'm sure nobody here does this, but people that I talk to sometimes, they think that they can beat the market, get in, get out. I'm feeling like this, I'm feeling like that. I'm going to sell this because I'm feeling like the market's not really great here. Well, if you notice, if you do watch the markets, a lot of days the market's pretty boring. It goes up a little bit, it goes down a little bit. Even 50 points, it gets it back, gives it back, gets it back. So by trying to time the market, you can miss really what the market action is. The average return of the S&P 500 is about 8% over the last 20 years. And if you miss the top 10 days, it goes from 8% to 5%. So just by if you're feeling or you try to time it a little bit and you miss just 10 days of action, you lose 3%. And if you really mess around and miss the top 40 days, now you're having a negative return.